Hi guys, this is Moses Jerry from MJ Forest. This is lesson one, introducing guidelines to becoming a successful forex trader. I know you have heard of forex before. In fact, that's why you are here. Maybe you have heard of the word forex from a friend, a family member, maybe online, and you have made up your mind that you want to go into this venture, into this industry as a trading, especially choosing forex. Be it a beginner, or maybe you are an individual or a trader that has been on this in the forex industry for long but without profitable result. This guide will walk you towards becoming a successful forex trader, because take note, there are many traders in the forex industry, but there are few for successful foreign traders. One thing that distinguish between the successful ones and the average ones is the amount of experience, insight, and skills they are able to get towards the journey of their forest life. So now this guide, one of the things that this guide will lead you towards is it will like shape you with the proper things that you need to know. It will build your experience, it will build you with skills as you stay on this MJ industry. One thing that you will get to know is that you will discover that there are certain things that you need to know, you need to engage into for you to be successful. And if you are a beginner in this industry, let me walk you through the basic. What is forex? Forex is a global electronics marketplace for trading or exchanging international currency. And when we say forex has to do with exchanging international currency. So it means maybe you are trading this country currency to that currency or the other country currency to the, or let me say for example, maybe you are trading United dollars with Japanese yens dollar, or maybe you are trading Japanese yen dollars with, maybe let me say Great Britain pounds. So all this, and so that's one thing with market, but it is an electronics marketplace. It is not like, let me say if it is online, it is electronics. The second thing that you need to understand concerning what a forex is that now the forex market operates 5 days per week. So it is on Monday to Friday, Saturday and Sunday they are break, but Monday to Friday the market is on, and it is 24 hours per day. So it means within these 5 days trading days, you can trade whether in the morning, in the night, depending on the time zone you are. Any time zone you can trade 24 hours, the market is on. As long as it's from Monday to Fridays, the market is on. Next, how we get profit in the forex market, just like how other business are. Forex market or forex industry is also a business, so you have to know the basic way in which you get profit in this industry. And one of the things that you need to know concerning how we get profit in this industry is that the basic principle of the forex market is liquidity. That is money. If there's anything that the market knows, is money. As long as there's no money, there is no market. So the basic things that controls the market is the amount of liquidity or money that is present in the market. The second thing that I want you to know is the market works on the basic of supply and demand. This means that if the market is going up or down, is based on the amount of liquidity that is towards that direction. So if the market is going up, it means the liquidity present is pointing towards that direction. If the market is going down, it means the current liquidity is going towards that particular direction. So the only thing that the market respect is liquidity. Whether going up or down is based on the direction of the liquidity. Now the third thing that you need to know is that now your profit in this forex industry is your ability to predict the market direction. Now everything that you need to know in this industry has to do with this. Every skills and experience you build has to do with prediction of the market direction. So as long as you are skillful to predict the direction of the market, that's when your profit is. So these are one of the basic stuff that's distinguish between successful traders and let me say an average trader. Their insight, what do they know, the skills that they have, the wisdom that they have in prediction of the direction. So now, for example, let me show you this. If, for example, now let me say this is what we call a chart. If, example, let me say the market is here, and you as a skillful trader, you are able to predict that market is going up just from, let me say, from here, you are able to predict that market is going up. So as long as the market start going towards your prediction, you are on profit. And just like here from this cycle here, once you predict from here the market is going up, you are in profit. The same way around, if you are, the market is here now and you predict that the market is going down, that it means you are on sell. As long as the market is going down towards this direction, you are on profit. So now these are one of the basic way you get profit in the forex market. Know that the market, the only thing that the market respects is money, the amount of liquidity that is there. And for you to get profit in this market, you have to know how to predict the market direction. Now, as a trader, I want you to understand this. There are basic fees. There's what we call a fees in your trading journey, and they are simplified into three. Because one thing that you have to know is that one of the reasons that some people, they are, let me say, they are consistent today, they are consistent winners today, they are losing tomorrow, is because there's an experience that they were not able to get at a particular phase, or there's something that they skip at a particular phase. There are three phases that define success, three phases that you have to undergo as a beginner or as someone that want to be successful in the forex trading industry. For you to you have to undergo these three phases. One of the basic phases, phase one, is you have to undergo what's called the learning and the demoing phase. That is phase one. Now in this phase, there are basic things that you need to know. But one thing that I want you to understand concerning this phase is that this is not the phase to make money. Because I know you have come as a beginner, you have seen or heard of people making money. Yeah, they make money in this industry. But as a beginner, the first rule that you have to know is that as a beginner, you are not here to make money first. What you need is what we call, you have to learn. You have to learn, and then you need to have what we call a demo account. A demo account is just like an online account that will give you access to the market. It will give you everything that a trader is doing in the market, but the only thing is that you cannot remove money. So there's a demo account. So you use the demo account to be back testing or to be trying everything that you have learned in the first phase. You'll be trying it in the demo account. Remember, I told you earlier that this phase is not to make money. This phase is to build skills, to build experience, to understand what the market is, to build certain things that you need to know in this phase. One of the basic things that you need to know in this phase, that you get to know in this phase, is number one, you have to know the fundamental basic of the forex market. Now, fundamental basic means you have to know the certain little things that define the forex industry. Let me say that, for example, if you are in an institution as a basic, as a new student, there are certain things that you have to know. So now, even in the forex industry, there are certain things that you have to know as a core basic. You have to know them. The second thing that you have to know in this phase is that there are basic tools that you need to know. What are the basic tools that you need to become a forex trader? There are tools, because everything that you engage into, not even in forex industry, there are things that you need to have that define what you are doing. The same thing in this forex industry. You have to know the basic things that you need even as a beginner to be called a trader. Now the third thing that I want you to know is, now, what defines success in forex industry. Now this phase will guide you towards what defines success in the forex industry, because this is one of the basic difference between successful people and people that they are just like, let me say, shadow boxing in this industry. Because there is specific things that they need to know, and they knew it at the right time. If let me say, because one thing that with my forex is that, you see, forex is a very large market. There are large information in forex, but one of the problem of failing in this industry again is knowing much without knowing the basic thing that you need to know. Now this phase will define the basic things that you need to know, the basic things that defines success in the forex industry. You get to understand that this is what I must know if I want to be successful. This is what I must know. This is what is not necessary, but this and this, it is compulsory for me to know. So as a beginner in phase one, you have to know that one, I told you earlier that the phase one is not for making money, it's for learning and demoing. And in this phase one, you have to know the fundamental basic of the forex market, the basic tools that define that make you to become a trader. The third thing is that what defines success in the forex industry. Now this is the phase two. Phase two is all about assessment and adjustment. Now in this phase two, this is when you are going to use real money, but you can use a very little amount of money. Still, it's not to make money, but in this phase now you are going to use your real money, a very little amount. You can, based on your broker, you can use $5, $10, $8, $20, $50, just the amount that you know that you can afford easily. Now you are going to use this to assess and make certain adjustments that need to be made based on your experience in the first phase, because you have to know that there's difference between a demo account and a real account. Once in this phase now, you start learning how to use your real capital, a very little real capital, so that at least, because you know here, since it's real capital, there's emotion. First, it's not your money, it's demo account. You can trade anyhow. Maybe there's this lack of proper discipline because it's not your money, you don't know what loss is all about. But now this is your real end capital. You are going to use small little amount, still not to make money, but to experiment the reality of the market with your real capital. One thing that you have to experiment and you need to make assessment on some of the areas is, number one, you need to know the reality of the market with your real capital. You experiment the market with your real capital and you make some adjustment about the market with your real capital. Two, the reality of the strategy. Now you have to get a strategy. You get a strategy. After your strategy, then you assess the strategy, because the phase one will give you a strategy. So in this phase two, you assess this strategy with your real money, and if there's area that you're making mistake, you make amendment. The third thing is the reality of you as a trader. No, even you as an individual. Since I told you earlier, the first phase is a demoing account. Now this is a real account. So you are going to experiment who you are as a trader. You get to understand things that are like trading psychology. There's the psychology will come in, your greed will come in, fear will come in, but gradually you'll be able to adjust them. Even though these are things that you can't trim at once, but gradually you adjust them using your real capital. So now these are the basic three aspects that you need to make assessment and make adjustment in this phase two. One, the market. Two, your strategy. Three, you as a trader. The third phase is what we call accumulation and distribution phase. Now this is the phase to make money. So even though this is the phase to make money, you have to now select what way or which equity will you use. That is, which money will you use. First, you can use your personal equity. Maybe you are someone that is financial buoyant, you can fund $1,000, $10,000, $50,000, depends. So if you are that kind of person, you can use your personal account. Or maybe if you don't have that money, that equity, that amount of equity, you can use what is called a prop firm. Now a prop firm is their institutions, their financial institution that gives traders money. That will give it money, you trade. So based on percentage, like the interest, it will be based on percentage. Any interest that you get, there's percentage. They have their own, but they can say 50%, but you have to know that the money they give to you can't remove the money. The only one that you can remove is the interest that you are able to get as a good trader. So that's one thing that make forex journey now very easy. All this saying that you need large capital, you need this capital, no. With a very small amount of capital, as long as you are skillful, you have experience, you can run forex. All you need, if you are capable, financial capable, you can use your personal equity, it's okay. But if maybe you are starting financially and you need assistance, you can use prop firm to generate your equity. You can leverage on prop firm, make your money, give them by their percentage. In fact, last you are trading, you are getting up your percentage, then they are getting their own. That is all. Then the third thing that at least you have to know concerning this third is what I call master class. That's further study. So even as you're making money, you keep on studying. You have to keep on studying, because knowledge never ends. So you keep on studying, you keep on studying, you keep on studying. So now these are the basic three phases that you have to undergo to be successful in this forex industry. So now let's go to the phase one. Just as we have said, the basic target of this phase is that it's not to make money, it's to learn and to demo what you have learned. As we have said earlier, we said that one of the basic things that you need to know about the phase is the fundamental basic of the forex market. Now, one of the first fundamental basic that you need to know is that the participant in the forex market. Now, who and who is in the forex market? Now, the first people that you meet in the forex industry is what we call the institution or the banks. Now, they are the main liquidity provider. These are the institution. They are the people that form the forex market with large amount of, in fact, almost 70 to 80% of liquidity present in the market is being funded by them. So they are the main people that provide the liquidity. Now, the second people that they are present in the forex market is what we call the brokers. Now, the brokers, a forex broker is a financial company that gives trader access to buy or sell foreign currency. Now, they are intermediary between the market and a trader. Now, one thing that the simple aspect of this broker is that a broker is just a middleman between you and the market. Just like now in a physical life, we have what is called a bank. A bank, as long as you want to make transactions, you want to keep money, you need a bank, you save your money. So now in the digital world, let me say in the online world, in trading industry, you need a broker is just like the bank. They are the one that maybe if you want to buy, if you want to sell, you buy through a broker, you sell through the broker. So they are the one that will connect you to the market. They are the one that will buy for you. They are the one that will sell for you. They are the one that will convert the money for you. Everything. They have a system designed that they have their own personal system that they have designed for that. The third participant in the forex market is you, the trader. So we have you, we have the broker, that is the middle person, we have the institutions that provide large amount of capital in the market. Now, the second thing that you have to know as a core basic is what we call a currency pair. Now, currencies are always in pair. Now, in the forex industry, currencies are always in pair. There's nothing like maybe you want to ask how much is dollars. No. You can ask how much is GBP USD, that is how much is pounds/dollars. There's nothing like, let me say, a stand-alone currency. No, in the forex market, how it works is that because we know what we said earlier, we said that forex has to do with exchange of currencies. So it means which currency are you exchanging with which currency? That's how the forex market, you are always exchanging one currency to another. So currency in the forex market, they are in pairs. So now, just like here, GBP USD, JPY USD. The first and the second alphabet signify the country name. That is, for example, this GB signify the country name, that is Great Britain. Then the third alphabet signify the country currency. That is this P signify pounds. Just like here, US, the first and second signify United States. Then the third one signify dollars. The first pair, that is GBP, is called the base currency, and the second pair, USD, is called the cut currency. So it means this GBP is called the base currency and USD is called the cut currency. So now these are the basic things that you need to know concerning a currency pair. Even though more videos will be dropped concerning this, so that at least it will be, that's when you get to understand there are types of currency pairs, there are things that you have to know more. But for now, these are the basic things that you have to know, that currency are always in pair in the forex industry. There's nothing like stand-alone currency. Currency you have to take because you are trading this to that, that to this. That's how currency. You are trading maybe GBP to USD, Japanese yen to USD, and know that the first pair is called the base and the second pair is called the cut currency. Now, the second core basic that you need to know is what we call a pip. Now, a pip means percentage in point. It is a measure of the difference or change in value of a currency. So now it means this pip is just differentiating this change in the value of any currency pair, how currency is rising or currency is dropping. That's what pip means. Now let me see, it is measured in decimal. Let's say, for example, Now, if GBP USD, this is the currency pair that you are buying. Remember what we said concerning currency pair. Now, let's say that this is the currency pair that you are buying. Maybe let's say that it moves from 1.2200. Let's say that now this is the amount that you buy or you are selling this currency pair, and then it moved to 1.2210. It means that's how many pips? It means 10 pips. So now remember what we say. We say pips, they are always in decimal place. So it means this 2200 is what is called a pip. So from this 2200 to this, it means there's a change of 10 pips. There's an increase of 10 pips. So it means there's addition. This currency pair increase with 10 pips. So one thing that I want you to know concerning a pip is that a pip always calculate the change in the currency pair. So whether pair is going up or is going down, that's is pip that is measuring that. You will know it from checking your pip, and pip is always in decimal places. The third or fourth thing that I want you to know is what is called a lot size and a leverage. A lot size is the amount of contract or a number of unit a trader is buying or selling per position. Now, lot size is all about the amount of currency pair you are buying. Now, for example, now let's say that you are buying GBP USD. Now, the amount of GBP USD you are buying is called lot size. Let's say now again, it's called lot size. If now let me say you are buying, let me say you want to buy this currency pair GBP USD, you want to buy, let me say like you want to buy 20 or 30. Now it means you are buying 30 amount or lot size of GBP USD. Next, leverage. Now leverage is any borrowed money that a trader use in forex market. Now let's say for example, if you need $10,000 to buy GBP USD and you are having $1, now the additional $9 is called your leverage. So one thing that I want you to know concerning leverage is this. There's this saying that if you want to trade, you need large capital. Yeah, if you can afford large capital, it's okay. But if you don't, there's a system that has been designed in the forex industry called leverage. That is true. You remember we say concerning a broker, we say a broker now is your access to the market, is your middleman to the market. Now, each broker, there's a percentage of leverage that they will give to you. Maybe let me say you have small capital and what you are expected to get is more than what you are having currently. Your current capital, so your broker now will give you the additional amount. But once you are making profit, the broker too is making profit because he's one that added the amount of liquidity that you need to trade that you need to trade at that moment. So it means with a very low amount of, maybe let me say $5, you can trade. With a very low amount, $10, $100, one time you can trade. You don't need one large millions of dollars. No, with a very small amount of currency or with liquidity or money, you can be able to trade with a system called leverage. Now, the second thing that we said earlier concerning the core basic is that you have to know the basic things that you need to become a trader. Now, one of the first basic things that you need to be a trader is you need a notebook and a pen. This is a sign that at least you are serious with your trading life, because success, one of the way that successful people are being judged or they are being rated is how good they can document, because human beings, they are not machines. Your seriousness is being seen in how good you can document your own findings. You can keep proper record. So you use this notebook, even in this forex industry, to document your strategies. You document your mistakes, your profit, why you make profit, any experience that you have, and you document it. They are just like your trading journal. You document every stuff. The second thing that you need to be a trader is you need an Android phone, because you need an access to internet. So you need an Android phone. The third thing that you need is you need trading platform. Now you use this trading platform. It is that's one of the platforms that you need to have access to the market. You need maybe things like MetaTrader, for that's MT4, MTO, MT5. You have to download one of these, or etc. There are many trading platforms, but you can start with MT4 or MT5. The fourth thing that you need is a broker. You know what we say? We say broker is your access to the market. So once you get your trading platform, in your trading platform, you download your broker, you select the broker that you want. There's a basic specification on selecting broker. You check, you select your broker, the broker that you want to, based on your country, based on the requirement. Then you select your broker. The fifth thing that you have to get is a computer system, if possible. If you can afford a computer system, it's okay, but if you can't, it's okay. You can still stick to your an Android phone. It's still okay. It's very good. It's all about this thing is starting. You start, you grow gradually. Okay, so how to be successful in forex industry? You know what we said earlier? We said one of the things that this guide will give onto is it will make you a successful forex trader. So now, how are successful people defined? If you want to be successful, how are successful people defined? Now, to be successful in forex industry, number one, you need a very good working trading strategy. You need a good trading strategy. You need, because one thing that you have to know about the market is that you don't control the market, but you control your strategy. You come with a proper, you test run the strategy, you at least experiment the strategy, then you take it to the market. Each successful trader have a very good trading strategy. Your trading strategy is based on the kind of person you are. It's based on what you decide to, but you get to understand the core basic of building a very good trading strategy. The second thing that defines successful trader is their risk management system. Now, one thing that you need to know about the trading industry is that when you see people losing money, one of the reasons is that they don't have a very good risk management system. When you see people saying things like trading is gambling, is because they don't have a very good trading system, a very good risk management system. I mean to say a very good one, because it's risk management system that will tell you that this is when I need to stop, this is when I need to, this is my stop loss, this is my guide, this is what I need to do, this and that. This is what will define conditions. These are your conditions. They are like your roadmap that define everything that you do in the trading industry. As long as money is concerned, they are the one that controls your money. They tell you what to do. Now you get what is called a risk management system. Now the third thing that defines a successful trader is what we call a good trading psychology. Your insight. What is your psychology about trading? How you build your psychology about trading. You build psychology about how to enter the market, how to control your own appetite, how to control fear, greed, all these natural psychological stuffs. So how good your trading psychology is define your success in the forex industry. Now, these are the basic three things that define successful people in the forex industry. Now, but we are going to work towards these three things. Everything that this platform, this MJ Forex will grant onto, it has to do with these three. It will equip you to be a very trader about building, teaching you how you build this, because we are not here to be doing many things. These are the core basics that you need to build your life in as a trader. They are very, very important. This is what defines success and what defines not being successful. Now, next, trading strategy. Now, the first thing that we're going to do with is this trading strategy. And one of the basic things I want you to know about this trading strategy before we start building a good trading strategy is what we call the candlestick. Candlesticks is a representation of a set of individuals in the market. Now, you know, in the normal market we have individual, we have people. Now in this forex industry, it is candle, it is chart that you see. So each candle that you see is what defines the nature of liquidity, that is the nature of people. Is it the kind of people, liquidity that are present in the market? This is what candlestick. It is a significant of the representation of the nature of individual or the nature of money that is currently present in the market. There are two types of candlestick. Number one, there is a bullish or the buyer's candlestick, and there's a bearish or seller's candlestick. These are the two types of candlestick that is present in the market. Now, for example, let's say for example, now this is the bullish candlestick. Now in the bullish candlestick, we have what is called the body. There's this thing that look like stick here. That's what we call an upper wick or a shadow. Then the down one is called lower wick or a shadow. There's the opening and the closing. Just like the bearish here, there's the body, the same thing. There's the upper wick and there's lower wick. The only difference is the opening price and the closing price. This is the difference between bullish and bearish. But the color, you can change the color based on your desire. You can make it purple if you're a lady, this one purple, this one pink, or you can make this one black, this one white. That one is your decision. Once you go to the trading platform, maybe your MT4 or MT5, you can there's different things that you can do. They can change the colors, but the basic difference now is, you see, in the bullish candlestick, the upside is the closing price, then the downside is the opening price. While here, the upside is the opening price, then the downside is the closing price. So now these are the two basic candlestick that we have in the forex industry. Next, now market structure. Now there are three major structures in chart, or maybe if in forex industry, there are three kind of structure. The first structure is the bullish market structure. The bullish market structure. Market structure just simply means the direction of the market per time. What is the direction of the market? Where is market going to? Where is market? What is the market doing at that particular time? So the first one is the bullish market structure. There is the bearish market structure, and there is the consolidation or ranging market structure. Now these are the three types of market structure that we have. Now for example, let me show you so that you understand more. Now just check this and see. Now you see the direction of this market. Remember what I told you? I told you that market structure is just like a definition of what is the market doing pattern, where is the market heading to. Now you see here, from this is starting of this chart. This way it started from this point, it's going up. So it means that this market is going up. That's the first type of market structure. It's called a bullish or a buyer's market structure, an uptrend. Once you see the market is going up, we call it a bullish market structure, or we call it uptrend. It means the market is going up. It means buyers are in control. Remember we said there are two candles. There is a bullish and the bearish. No, there's also three market structure. There's a bullish buyers. It means buyers are in control in this market. Now buyers have serious liquidity in this market. Now this chart, this is line example of market structure. Now you see it just like here, from low to high, low, high, low, high, low, high. Just like here also, you have low, it's going high, it's going low, it's going high, it's going low, it's going high. So this all call, you see, from this low, it started from this low, it went high, it went higher low. It means this high, this low now is higher than here, so that's why it's called higher low. Then it went here, it means this higher high, this higher high, this high is higher than this particular. That's why it's called, this high is higher high because it's higher than here. This higher low because this low now is higher than this. So we have low, we have higher high, we have higher low, we have higher high, we have, just like here also, we have low, we have high, we have low, we have high, low, high, low, high. This bullish market structure, an uptrend market. It means the market is going up. It also means that buyers are in control of the market now. Now the next is called a bearish market structure. That is downtrend. It means sellers are in control. You see it from this line representation: lower low, lower high, lower low, lower high, lower low. That is you see from here, lower low. You see here is going up, went down, went again, went here again, went here. You see from here, this one here is lower than here, this one here is lower than here. So that's why we have from here went down, is going, that's the same thing that I say. You see high, you see lower high, lower low, lower high, lower low, lower high. Why is it lower low? Because this low is lower than here. Then why is that this high is lower? You see this low, this high now is lower than this high, so it's going low. It went printed this high, it went this lower, this low now is lower than this high. So that's how it is. It means now bearish or sellers, they are in charge of the market. Now the third one is what we call consolidation. Now in consolidation market structure, you see ranging market structure, you see how it is. It means from here, this is where it started, it went here, it came back to the same point, it came back, it went down again to the same point, and now went back again to the same point. So it means, you see from here, this high now, they are all the same, and this low, they are all the same. So there is not a fixed direction. The direction is just ranging, is going up, is going down the same point. This is what we call a consolidating market. The market is just maintaining the same support, the same resistance. It's just in one place, going up the same point, it will go down. Not like compared to here. Compared to, you see from here, it started from here, it went low, it never went back to this particular high again. It's just going down. But here it will go, it will retest this place, to go. So now this will quite constant, just like here also. You see it started going uptrend, it started going up. So at this point now, this rectangle here, it maintained a consolidation. It was consolidating here, it maintained this point. You see the point from here, it went down, it stayed this place again, stayed there, you went back here, the same point, it went back. So that's what we call by consolidation. 3, market structure. Bullish means the market is going up, buyers are in control. Bearish means the market is going down, sellers are in control. Then consolidation or ranging means the market is in a particular fixed point. Next, market order. Now one thing that I want you to know before getting a good market strategy is that you have to know what is called market order. Market order simply means the time a trader wants to buy or sell any currency. Now it is time dependent. It can be instant execution or order execution. Now this instant execution means a trader want to buy immediately now, or order execution. In this order execution, there are different order execution. There is limit order, there is buying limit, there is sell limit, there is stop. So those ones, they are not for now. The basic thing that I want you to know is instant execution means that a trader is placing the trade immediately. It's just now, I want to buy now, or I want to sell now. Anything that I want the broker to do for me is now. Now the third thing that the other thing that I want you to know is what is called a time frame. Time frame refers to the duration of time that each candlestick represents on a chart. The time frame of a trader is based on the type of the trading style. Now, one thing I want you to know concerning time frame is that time frame just define the duration of each candle. You get to understand that there's even different candlestick, there's different time frame of every candlestick, what it takes, how many minutes or how many seconds or how many hours, or what is the duration of this particular candlestick. And this time frame has to do with you, the trader, the kind of trader you are, the style of trader. Are you a scalper? What kind of trader you are? Because the kind of trader you are defines the time frame that you're using. If you're a trader that maybe you want to let me say, and you want to maybe one day you are done with the market, all these things, that's when your choice for time frame comes in. Types of traders. Now one thing I want you to understand is that there are 4 major types of traders. So, and the choice for your trading type is based on the kind of person you are. You will check the recommendation, then you check the kind of trader or the kind of person that you are, the nature of your patient, the nature of. Now the first trader here we have is called day trader. Now in day trader, most of the day traders, they buy and they sell currencies on the same day. every activities of a day trader has to do with one day. You do your things, you get your money, you do everything just raise it. Why? Because now they're just suitable for one, high risk appetite. They have a very high risk appetite. They have high capital, they have high time commitment. Now they have time to stay on chart. If you are someone that maybe, let me see your schedules, you don't have serious schedules per day, you can be a day trader. You are always on chart, you are there, you check what the market is doing per day, you buy or you sell, you remove your money, you are done for the day, you wait for the next day again. Or you can be a swing trader. Now these are traders that they hold position or they hold what they are buying for a few hours to weeks. So now this kind of traders, they can maybe, let me see, buy today, they will leave it, they will not end it, they will leave it maybe 1 week or 2 weeks, they are still there. One, they are just suitable for now moderate risk appetite, moderate capital, and decent time commitment. Then maybe you are someone that don't have let me say all day to be staying on chart, you can be a swing trader. You see, that is the kind of person you are. There's no any trader that's better than any trader. It's just the kind of your personality, the kind of person you are, your time schedules, your risk appetite, the nature of capital that you have. So all these things. Now the third kind of trader that we have is what we call position traders. Now position trader, they hold position for weeks, months, even years. They can hold it for more than 1 or 2, 3 years. These are the kind of people they are. Why? Because now they have low risk appetite, they have moderate capital, and they have low time commitment, especially that time commitment. If you're an individual that you discover that maybe you don't have time to trade, you can't even trade for 1 week, 2 weeks because you are busy engaged, you can be a position trader. It's just who you are, the set of the kind of person you are. The fourth kind of trader that we have is scalper. Now profit from small price changes. Then what they are after is just, let me say, like 5 to 10 pip, 15 pip, they are out. Once the market just move addition of 10, 15 pip, they are out of the market. So then they can even place like 20 to 30 trade per day if they want to, or 15 trade per day, or 10 trade. Not like a position trader that will leave it trade from, let me say, months, years. Then they can leave it 3 years before removing their trades. Or like swing traders that can leave it for weeks, to 1 week, 2 weeks, 5 days, then, or maybe a day trader, maybe that, let me say, you trade for 1 day. That is unknown. That is scalpers. Then they are just after just small peak movement, they are removing their money. So you check this, you check your personality, you check the kind of person you are. The kind, just like me, I'm a day trader. Even though I scalp sometimes, but I'm a day trader, because at least I have time to like be on chart. At least maybe I can skip 1 day, but at least I can trade for like 3 days per week. So after, let me stay on chart, let me do this, let me make my analysis. I mean, the choice for the kind of trader you become is based on the kind of person. So just check it and see. You check it and see, check the kind of person you are, then check the requirement, then you select the kind of trader that you want to. So let me take you to the chart so that you see some of the things that we have been dealing with. I told you that one of the tools that you need as a forex trader is a trading platform. And I told you earlier that you have to download, is either you download MT4, that's MetaTrader 4, or you download MT5, MetaTrader 5. Well, there are many trading platform. Like on this case study, I'm using TradingView as a trading platform. So if you're using your Android phone, you just go to your Play Store, you download MT4, or you download MT5, or you download TradingView. Just go and download MT4, MT5, one of these two. So this is a trading platform. This will give you access to the market, to know the app news, the activities of the market. I told you earlier, there are two kind of candlesticks. I told you there is a bullish candlestick, there is a buyer's candlestick, and there is a bearish candlestick, that is seller's candlesticks. So now in this, you see, these are my two candlesticks. You see, it's either you see red or green. So in this, my platform, I'm using green as a bullish candlestick, and the red one as the bearish candlestick. You see the candle wick, these are the candle wicks. These are the candle wicks. You see it, all the candle shadow. This is the body of the candle. So these are my candlesticks. So once I see this green, I know that once I see green like this, I know that it's buyers. Buyers are taking over the market. They are going up. Once you see red going, you know that it's going down. It's sellers that are taking over the market. And we make mention of what a pip is, and we say that pip means percentage in point, and we said that it's measured in decimal place. Excuse. We said that it's been measured in decimal place. If you come to by my right here, you will see here is indicating 1.27. You see it how it's ranging, it's changing from 1.270, it's going 1.27. So these are the pips. Now this is where the market is currently. You see where the market is. This is where the market is currently. Now is 1.27985. So once the market is going up, you see that the pip it will be indicating automatically, and once the market is going down, is to be indicating, because now it's a live market. You see it's reading here 57 seconds, 56 point something seconds. So now this one is just 1 hour time frame. Here you see the time frame, so we make mention of a time frame. So any time frame that you want to see, it's just this time frame. Now it means before you see another candle being formed, it have to take 1 hour. Before once I enter this my hour, now if I should make it now 15 minutes, and let me enter 15 minutes. See 15 minutes here, change to 11. So it means each one candle, before one candle be formed, is 15 minutes. Each candle represents 15 minutes. 15 minute duration before one candle will be formed. 15 minutes. Once we go to 5 minutes, also this 5 minutes, it means each candle, you see it here, it changes. So it means each candle will be formed after 5 minutes. Once 5 minutes pass, another new candle will come. So now you see that this candle now will be formed after 5 minutes. If I should take it to 3 minutes, you see it. So it means each candle here will be formed after 3 minutes. Or if I should take it to 1 minute, it means now each candle here will be formed after 1 minute. Once 1 minute reach, you see a new candle. So time frame is just based on the kind of personality, the type of trader you ask. You know what we say? We say that there are 4 types of trader. We have the scalpers, the day trader, the swing trader, and the position trader. It's just based on your personality. So each time frame that you're using here is based on the nature of trading type or style you are using. So let's go back to our 1 hour time frame, because me, I'm a day trader. So now you see it. Now this is just a brief aspect of what a pip is and what a time frame is. By my left, just come to my left, you see it's reading GBP. This is what we call currency pair. Now the currency pair that I'm into now is GBP USD. But if you want to change your currency pair, maybe you don't want to trade GBP USD, you click on this, you click on the GBP USD. It will sorry, it's network. So this way it is. Now maybe you want to trade forex, you don't want to trade forex, you want to trade crypto or index. These are different commodities, but for this course we are trading forex. So one of the best advantage of the strategy I'm going to teach you is that you can use it to trade whether forex, crypto, bitcoin, any stuff you want to trade with it, you can use it. So now this is the currency pairs. These are different currency pairs. See, there's Europe USD, there's GBP USD, there's USD JPY, there's GBP JPY. So these are different currency that maybe you want to trade. You just select from here, then you trade. So this one to so now is always a currency pair. You select the currency pair that you want to trade, you select it, then you trade it. That is all. So now just this is a brief aspect for the market. You know, we say there is 3 types of market structure. So you see now, you see from this point now, the market was just going up. It just went up. You know what we said earlier? We said there are 3 types of market structure. There's a bullish market structure, meaning that the market was going up. So you see from this point now, the market was just going up. So it means that this market structure is bullish. It means it's the buyers that they are in control of the market. Let me just preview the chart, and the chart at this point here, you see from this point is just going down. It means this is a bearish market structure. The sellers are in charge of the market. They are the one that have the highest liquidity. You know what we said concerning forex? We said that the basic things that control the market is liquidity. So it means at this point is sellers that control the market. They are the one that have the highest liquidity. So they are the one that is in charge of the market at this point. Oh, let me show you again the last market structure. There's a place I saw it. Check it around here. You see, this is what we call a consolidation. You see it here from this point. Here was consolidating. You see it. Here was consolidating. You see it. There's no specific direction. So it's just going up the same point, it will come down, it will go up the same point, it will come down, it will go up, it will come down, it will go up, it will come down, it will go up, it will come down, it will go up. It's just on the same zone, the same horizontal rectangle zone. See it? This is what we call a consolidation. So just as we have said earlier, we said there are three market structures. The bullish, meaning the market is going up. Once you see market going up, just say that this is a bullish market structure. Once you see market going down, it's called a bearish market structure. Once you see a market ranging on a particular point, it's not going up continually, or it's not going down continually. It is the market is on consolidation, or there's a ranging market. The market is ranging. So these are just a brief aspect, the basic aspect of what forex trading is all about. That is for lesson 1, but in lesson 2 you get to understand how to build a trading strategy. I'll walk you through how we build trading strategy, what all these things signify. You see them, all these lines. You get to understand some of the basic of the things that you need in building a trading strategy. What defines a very good trading strategy? I told you earlier that that's one of the basic fundamental to be successful in forex industry. You have to have a very good trading strategy. You see it, I was by here. You get to understand why was it that I was going by, why was it that what was it that I saw in the market that made me to go up and buy at this point. You see here is almost 88.9 pip interest that I've gotten here. You see it, then you see, you get to understand that why is it I set this set, because even if the market goes against me, I'll not lose. This is the only amount I'll lose. This is one of the advantages of having knowledge, but without setting this, without understanding some of these things, once the market goes against you, you end up losing your money. So these are the things that you have to know in trading industry. It's not all about coming to make money, yeah, but there are things that you have to know, so that in case if the market goes against you, these are the things that will control the market for you. No matter what, you will not lose. You will not lose in more than what you want to give the market. You won't. Understand? But so now these are the basic stuffs. You get to know that why is it I went on buy here? What did I saw in the market that make me go went on buy in this at this particular point? So these are the things that lesson 2 will give on to you. You get to understand how to build a very good working strategy, trading strategy. You will get to understand what it's all about, a brief aspect of risk management. So just stay with us in this industry. Don't forget, if you are new on this channel, you tag on the subscription buttons. So thank you for staying.